How to read stock chart patterns. Okay, so this will be used with the stock market today. We're looking at Tesla one-day chart here, but this is not just for stock chart patterns. It's also for Forex, futures, cryptos, eminis, whatever you're trading. All right, now what we're doing here is we've got today's chart pattern we're going to look at is a triangle, a symmetrical triangle. So we have our lower high and our higher low. Now, one of the keys here is, and of course triangles are very well known, but they don't work quite as well as they used to back in the olden days. And that's because, well, everybody knows about triangles. Everybody knows about head and shoulders. Everybody knows these, basic patterns. And so they're actually gamed a lot by the professionals. And therefore, be very, very careful of it. In fact, you can't trade chart patterns in isolation. Just what the pattern on price is, that really doesn't mean anything. So we look at, that's what I call structure. So we look at structure, sure, we'll take that into consideration, but then we got to look at money flow, because that's what really matters. It's not just the pattern of price, it's that, sure, we can look at that, but what matters more is the money flow. Markets move up and down based on supply-demand imbalance. If there's more demand than supply, it goes up, more supply than demand goes down. And if it's even, they chop sideways. So that is the key. Now, we can combine that with structure, so let's just do that today since we are talking about chart patterns. All right, so I've, as you can see, connected the lower high, connected the higher low. And let's just go forward and see what happens. So what happens is, oh, we get a breakout. All right. Now, a lot of textbooks will tell you, hey, that's where you buy. Buy the breakout of the so-called trend line. And so let's watch that. Let's see how that happens. By the way, what I'm going to do is we go through this bar by bar on the hard red edge of the screen. I'm just going to kind of mimic how a trader might have their internal dialogue going. Might be kind of interesting to do that. See if you resonate with this. If you do, I'd be thrilled if you tell me in the comments if this sounds like some of your internal dialogue. All right, so boom. We are trading based on classic technical analysis, breakout of the so-called trend line. Uh-oh. And then the next bar, now how do you feel? We feel like, oh, dang it. The textbook didn't work. The textbook did not work. That's why they call them textbook examples, because they're perfect examples, and perfect examples don't exist in the real world. In fact, even whether you're in business school or whatever, they say textbook, meaning that, yeah, but that's not what happens in the real world. So it's the same with trading. That's why you need to be careful of trading books. And that's one of the things I don't like about most trading books is they only give you the perfect setup, and they don't address when things don't work out. And that's a big problem, because when you go to trade in real life, you're going to find a lot of times things don't turn out right or follow the textbook, because the market doesn't follow any textbook. The market is in the moment, bar by bar, what is the supply-demand imbalance at that time? All right, so anyway, we get a couple another bars going down. Now, if you were in, you're like, boy, I don't know, maybe you got out, or maybe you're staying in because it's still above the trend line. Oh, now it goes up, except it's a red bar, and red and green bars tend to influence us. And it goes up, but it's only a doji. So how you feeling now? Probably pretty uncertain. Maybe now you're looking at, oh, this high, this high, this high. You say, uh-oh, I don't know if it's going to break through the resistance of those three highs. Well, let's see what happens. Yay, it did. All right, now I'm off to the races. I'm making money. I'm going to have a beautiful retirement in Bali, and I can't wait. A little pause there. That's okay. I'm not worried. Uh-oh, now I'm worried again. Uh-oh, anxiety. Uh-oh, freak out. Uh-oh, oh my gosh. Now what should I do? Should I get out? Is this going to be temporary? And now uncertainty comes in. Now fear might come in. Let's see what the next one is. Neutral bar goes up but closes at the low, so that's not very helpful. Up, now it goes down but closes near the high. Well, now we got a green bar. Not sure if that's good or bad. Okay, oh, it goes up again, but god dang it, it's another narrow range bar. Oh, now it gaps down. Are you kidding me? Could you really stay in now? Maybe you put your stop below this here. Okay, that would be reasonable, right? And now maybe you're thinking, okay, if we can just hold this trend line here, if you extend the trend line onto the future, you're like, okay, that'll be my final line in the sand. If we don't, oh, are you kidding me? Those gall darn market makers, those specialists, my broker, everybody's against me. The whole market hates me. I'm a terrible trader. I'm such a loser. Don't say that to yourself. Okay, you're not a loser. But this is the kind, trading can be very emotional. Again, be very curious to see if these are the kind of thoughts that you have. I know I've been there, by the way. I'll be the first to admit it. All right, so now do you get out? Well, let's see what happens next. Okay, inside bar. Oh, seriously? Now it goes up. Are you kidding me? Was there an entry there? Answer, you betcha by golly wow. So let's see, what is that entry there? So that entry is the apex. Did I really just say betcha by golly wow? I think I did. That was embarrassing. Okay. So, and of course, it's very important that we put it right in the middle because there we go. We got it right. We got to get it right in the middle, right at the cross. And you know why? Because your broker, the specialist, the market, well, we used to be called specialists, market makers, they are looking at every pixel on my individual chart. Okay, that's called sarcasm. So the real point in that is don't think that your lines are all that special. Nobody knows which lines you're drawing in the pixels and all that kind of stuff. So take it as a rough estimation. But drawing off the apex like that is something that's helpful. And one of the nice things about taking this entry is you're getting in when the breakout traders have been wrong, the retrace and the throwback traders have been wrong, and all of them have now given up, and now you're getting in. And usually when everybody in their gerbil have given up, that's just about when the market, wait a minute, that's supposed to go up. Oh, it did. It gapped up. So again, just when even these people are starting to give up, then all of a sudden, kablambo, the market gaps up. Gaps up, where does it go? It's a red bar because, again, we're hitting this resistance zone. Again, don't worry about the lines. Just we're in the zone of this high, the zone of that high, the zone of that high. And then the next bar, oh, big wide range bar. Okay, and now look what happens. Now we get a couple more narrow range bars. Why? Because we're at this high. And people are looking at that and saying, ooh, I don't know if we're going to go bleep above that. So people are taking profits. And then sure enough, of course it goes higher. Why? Because now all the amateurs took their profits. And it'll probably stop there. Whoops, maybe not stop there. Oh, it actually gaps up. Are you serious? So just when the retailers are getting out, then the market continues to go up, up, up. How can this be? So, my friends, traditional technical analysis doesn't work all that great anymore. If you can Google it, then not going to work so well because everybody's trading it. And yeah, the market, I know this sounds paranoid, but the market is kind of out to get you. And it's not that your broker is looking at your account. The broker is not looking at my account. Those were jokes. I'm not that important, that the broker cares about my individual account or your individual account. That's not what's happening. What's happening is simply that the markets move differently now. You've got algos, you've got quants, you've got high frequency trading, you've got dark pools. That's what moves the markets these days. And so traditional technical analysis books, as much as I respect them and appreciate them and the authors, well, things move different now. Money flow moves different through the markets. And so it all comes down to timing, right? Timing. So again, by the way, you're welcome to get my personal timing indicator if you'd like to. Give it away for free to everybody who watches this video. And let me just say that it's no cost to you. I give you a little seminar with it. It's recorded. You can watch it whenever you want. It's a modification of a common indicator. But the key to it is this. When was the right time to get in? This was all about timing. Was this the right time? Notice I'm drawing it down to the time axis. See, we've got only two axes on the chart. Time down here and that's the x-axis, and price is the y-axis. And everybody's very fascinated with the price axis, as they should be, as you should be as well. But so many people ignore the time axis down here. But think about that. A chart's a two-dimensional object. It only has two dimensions. So, and we're trading probabilities. So if you ignore the time axis down here, you're ignoring 50% of the information on this two-dimensional object. How can you have a probability trade if you're ignoring that? So it all comes down to timing. Was this the right time? And the answer obviously was no. What about this? Was this the right time? It came right after it. Was that the right time? The answer is no. Was this the right time? Yes. That was the final cycle low. That was the time to get in, and then the market goes up. So we were able to combine, and by the way, it's not just time either, it's both. So this is the combination of time, the x-axis, and price, using our axis, or the coming together of the triangle. So time and price combined. And by the way, this is something that W.D. Gann used to talk about a lot, and it's amazing. And most people don't even, now I don't use it the same way W.D. Gann used it because, well, his stuff's anachronistic as well. Because he used to hand-drawn charts, and he actually thought daily charts were too noisy. He would use monthly charts, quarterly charts, yearly charts. Not many people do that anymore. But that's it, my friends. X marks the spot. Confluence. Let's see if I can get an arrow on here real quick for you. There we go. So it's the confluence of time and price that gives us precision entries. So that's the lesson for today. By the way, if you liked this lesson, you want to get more, feel free to subscribe to the YouTube channel here, and you'll be notified when new videos come out in the future. Going to be doing a lot more videos, a lot of great stuff. Want to make sure you get it in your hands. And of course, it's all free.